Welcome to today's episode of China Perspectives. I'm Harry Hu, Senior Director at Fitch, and I'll be hosting today's discussion alongside Ying Wang and Jeremy Zook, who, as you know, are the regular hosts of this podcast. Today, we'll be exploring EVs, AIs, and the next chapter of China's economy, with a particular focus on China's push to develop what policymakers call the new productive forces, and what that could mean for growth, industry, current trends in the years ahead. Some of our regular listeners may be wondering why I'm sitting in the host chair today. There's a good reason for that, and I'll share some exciting news towards the end of the episode, so please stay with us. Without further ado, let's dive into today's topic. Jeremy, to you first. New productive forces is expected to be a major theme of China's 5-year plan. What does it mean in practice? Why is it important for China? And how does China's approach compare with other major economies?
Yeah, thanks, Harry. So, new productive forces is really a bit of a broad concept, but generally, though, it refers to advanced industrial and tech sectors that the government in China thinks will be the new growth drivers, not just for China, but for the global economy as well. Really, we first started hearing this term sort of mentioned around 2023 as China was really beginning in earnest its transition out of property sector led growth towards what it views as sort of the new quality growth drivers. And the new productive forces were really part of that. But I think really it is a continuation of kind of the government's sustained focus over the past decade or so in really trying to build up China's technological prowess and its self-reliance when it comes to supply chains and industry more generally. So this has really been sort of part of the government's industrial policy plans for a bit of time, but is now just being better defined. So what are we talking about specifically here? Well, it doesn't really seem to refer to, say, a predefined set of industries, but it seems to encompass whatever the government kind of thinks will be pushing the global technological frontier, both in terms of existing as well as in terms of future industries. And so it really, I think there's a bit of an evolving definition and an evolving set of sectors within the industrial and tech space that the government will focus on. So far, of course, the focus has been on some of the EV sector, batteries, renewable energies. These are places where China has clearly done very well and has really pushed kind of the global frontier in a lot of these sectors. But there is, of course, a broadening focus into the AI space, both in terms of generative large language models, as well as physical AI like robotics, and then more traditional industries in terms of aerospace and pharmaceuticals. So I think, other countries are now kind of adopting a bit of this China approach to industrial policy. We're seeing around the world governments try to focus a bit more on pushing industrial investments into these new tech sectors, even in places like the United States, but certainly in Korea as well as Japan, we're seeing governments start to make a bit more of this push as well.
Thank you, Jeremy. So when Fitch affirmed China's A rating, industrial upgrading and technology were important parts of the growth story. How do new productive forces support that view, and what will determine whether they can help offset China's structural headwinds?
Yeah, look, I mean, this is the big question for China over the medium term. As I mentioned, China is trying to shift its economy away from being one that's driven by property and investment, infrastructure investment, towards one that's driven more by sort of high quality sources of growth and productivity. China is also at the same time as this transition, trying to offset some of the headwinds from demographics, from its aging population, and boosting productivity will really be a key part of that story. The government thinks that, focusing on these new productive forces will help to kind of offset those structural challenges and keep growth relatively high. Of course, investment in say, the property sector isn't necessarily super productive, and the market there was already quite saturated. So we do think that these investments in kind of new industries can be productivity enhancing and can be supportive of growth. Also, if China is able to sort of push the global technological frontier and become a dominant global player in a lot of these new industries, that in itself, we think will be quite supportive of economic growth. So our current baseline is that, growth in China remains relatively healthy above that of rating peers, but it is on a declining trend. So our estimate of potential GDP on average over the next 5 years is 4.3. But again, that growth rate is kind of declining over that horizon as demographics do kick in. I think, there are some downside risks to this outlook as well. There are some challenges that the government will have in making this transition. First of all, the property sector was just a huge part of China's growth story. And so replacing that property sector will be quite a challenge. And so that's part of the reason why we think growth is generally on a downward trend, because while these industries are supportive of growth, they can't quite offset the impact of less property sector investment. The other story is on the labor side. Of course, a lot of these new productive forces are very capital intensive. And unlike the property sector, which was very labor intensive, that's not going to be the case for these new industries. And so in terms of employment and wage growth, these probably won't be quite as positive of a story there. And so that goes into kind of the third challenge, which is domestic demand. Domestic demand in China has been a bit of a challenge. And in this case, if you're creating a lot of new supply, where is that demand going to come from for these new products that you're creating? It's either going to come from the global market or the domestic market. And we think without more emphasis on domestic demand, that could be a challenge for the growth story. And then finally, I think one other challenge is on involution. So we've seen a lot of push into these new industries, and that's led to very high degree of competition and very low margins for a lot of firms operating in these sectors. And there's been a bit of low exit from these sectors and less consolidation than one might expect. And so that in itself is leading to some downward pressure on prices and will be a challenge for the government to address.
Thank you, Jeremy. That was a very good overview of the sovereign and the macros. Let me turn to corporates. So Ying, EVs are one of the most visible examples of China's new productive forces strategy. What role do they play, and what do they tell us about both the opportunities and the challenges of industrial upgrading?
Thanks, Harry. Yes, China's EV industry is probably one of the clearest examples showing that China can really move up the value chain. So what makes EV important in this industrial upgrading agenda is that they sit at the intersection of several strategic goals, which include green energy transition, technological upgrading, supply chain security, and global industrial competitiveness. Pretty early in the years, China identified EV as a national strategic priority sector, and the government supported them through long-term planning, subsidies, tax incentives, and support for R&D. But there's no single factor that results in China's EV success today. In fact, China has built an entire ecosystem around EVs. Today, China has the world's most complete EV supply chain that extends from critical minerals processing to batteries, components, software, and final assembly. And China has the advantage, the scale advantage of a huge domestic market. This kind of big domestic market combined with very intense competition forces Chinese companies to innovate rapidly, cut costs, and bring models to market quickly. So this is why Chinese firms are not only strong in EV production, but they're also very strong in batteries and are becoming increasingly competitive in autonomous driving features and intelligent cockpit systems. So I think EVs tell a lot about the opportunities in China's industrial upgrading push. They really show that when strategic policy, market size, manufacturing depth, and private sector competition reinforce each other, China can create a globally competitive industry very quickly. However, at the same time, EVs reveal some challenges. So first of all, the EV industry is extremely competitive, with the price walls compressing margins and also forcing weaker players out. Second, as Chinese companies expand abroad, they're running into growing trade and geopolitical barriers, especially in the US and Europe. Localizing production can help to some extent, but that requires significant capital and brings execution risk. And third, although global EV demand is still very strong, it's still growing, but the pace of growth has moderated. So that means the external environment is becoming less forgiving. So I think overall EVs are both a success story and a stress test. They highlight that China has real strengths in industrial upgrading, but also China has the limits of an economic model that increasingly depends on export markets in a more fragmented global economy.
Thank you, Ian. Gets very insightful. So beyond EVs, China is putting increasing emphasis on AI and robotics, backed by initiatives like AI Plus and investment in computing infrastructure. Where do you see the biggest economic and credit implications, and which sectors stand to benefit the most?
I think the biggest economic implications of AI and robotics in China is that they are becoming the next major engines of industrial upgrading. They're not just new technology themes, they are increasingly tied to productivity, manufacturing, competitiveness, and importantly, China's strategic focus to reduce dependence on foreign technology. China's AI investment is heavily skewed toward infrastructure and hardware. A very large share of AI related investment in China is going into semiconductors, computing infrastructure, servers, data centers, and other physical components of the AI stack. So, this is a result of two realities. First, computing power is now seen as a strategic capability globally. And China, more so for China, under the ongoing US chip restrictions. And second, hardware is where China has a clear industrial advantage, given its deep electronics and manufacturing supply chains. So, in terms of the sectors that stand to benefit most, I think that would include semiconductors, AI infrastructure, data center supply chains, industrial automation, and robotics. These sectors and areas are likely to see the strongest near-term economic tailwinds because the demand is tangible, policy support is strong, and the commercialization path is relatively clear. And in fact, we can see from China's trade data that the growth in exports of integrated circuits, automated data processing equipment, and other high-tech products has become an important source of economic resilience. From a credit perspective, I think the implications are a bit mixed. First of all, for hardware-related companies, especially those with very strong market positions, this ongoing AI demand boom can support revenue growth, capacity expansion, and potentially stronger cash generation. But it can also lead to heavy capex cycles, increased execution risk, and in some cases, there's looming overinvestment risk if supply runs ahead of demand. And then on the software side, China's large internet and platform companies are also investing aggressively in LLMs, algorithms, and AI applications. So our rated Chinese internet companies such as Alibaba, Tencent, Baidu, and others are clearly positioning for the longer term. But I think for them, the credit impact could be less immediate because software monetization is still less certain. And although we don't see material near-term pressure on their margins and cash flow for these, they're very giant companies, but I think the long-term returns of their large AI-related investments still remain highly uncertain. So overall, I think the biggest beneficiaries are likely to be hardware, infrastructure, and automation-related sectors in the near term. But the longer-term upside will depend on whether China can translate heavy AI investment into sustainable commercial returns and productivity gains.
Thank you, Ying. Just to quickly wrap up, what's the one indicator of development you'll be watching most closely over the next few years to judge whether China's new productive forces strategy is genuinely succeeding? Ying first?
I think it really depends on how we define success. If success means building global leadership in strategic industries, then China is already a global leader in EVs, batteries, solar panels, wind turbines, drones, and a range of other high-tech manufactured products. And I'm fairly confident that China's exceptionally deep manufacturing supply chains, combined with strong R&D spending by industry leaders, will continue to support gains in both global market share and productivity. But if success is defined more broadly, meaning whether such industrial upgrading can also rebalance the economy in a more sustainable way, then perhaps the picture is less clear at this point. As I mentioned earlier, China's high-tech manufacturing push still heavily depends on exports. So that does create vulnerability to weaker global growth, trade barriers, and geopolitical tensions. So I think the bigger long-term question is whether this industrial upgrading can generate enough quality jobs, higher household income growth, and ultimately stronger consumption. This is probably the real test because Jeremy mentioned that, weak consumption remains one of the main structural challenges in the Chinese economy.
Yep. And you, Jeremy?
Yeah, so I think there's really two key things here. First, watching what happens when it comes to challenges around overinvestment and involution, and whether firms are allowed kind of to exit if they become unprofitable. I think, if you have firms sticking around that are ultimately not profitable, that of course is a drag on productivity. So if we see less in the way of overinvestment and less involution, then I think that would be positive for potential productivity gains. And the second, I just want to echo kind of what Ying mentioned around kind of the domestic demand story. I think, ultimately making this growth from new productive forces sustainable is about also generating that domestic demand and becoming less reliant on the external markets, where you're more prone to volatility and trade barriers and disagreements. So I think having that domestic demand source would certainly make this much more sustainable growth model.
Thank you both. At the beginning of the show, I mentioned that we had some news to share. Well, that moment has arrived. Rather than me giving it away, I'll pass it on to Jeremy and Ying, who share the excitement with all of you.
Yeah, so thank you, Harry. So the big news is that this will actually be the last China Perspectives episode.
That doesn't sound very exciting, Jeremy. What's going on?
Yeah, well, hang in there, Harry. As I mentioned, the final episode of China Perspectives, we launched China Perspectives 5 years ago in order to provide our listeners with credit and economic views on credit and economic developments in China with various industry experts, economists, and policymakers, both within and outside of Fitch. Overall, we've recorded 48 episodes since the launch.
And since 2021, you have been listening to and supporting us on Apple, Spotify, and other podcast platforms. We would like to thank you very much.
Yes, thank you very much to all our listeners.
So what's the exciting news?
So we are now going to expand the podcast to the whole Asia Pacific region with your long-term support. And this new podcast is called APAC Credit Cast.
Now, that's something that sounds pretty exciting.
Yeah, certainly. I mean, on this new podcast, you'll still be able to get Fitch's forward-looking opinions and commentaries on the topics that are interesting to you as investors and people interested in general economic and credit trends, as well as, very in-depth conversations with experts from various organizations outside of Fitch as well.
Yes, we are looking forward to continuing the conversation with all of our speakers on APAC Credit Cast. So please tune in and join us for the first edition of APAC Credit Cast, which hopefully will be coming soon.
So this isn't the end, but rather the beginning of a new chapter. I hope you guys are all as excited as I am. So bye for now and stay tuned.
Bye.
Bye.
You've been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. Subscribe to China Perspectives wherever you get your podcasts.